Hey guys, we're live with the Holy Macro Show. Apologies, had a bunch of internet issues and then computer issues, and these things happen from time to time. Video is off for today. I know you guys are probably very upset you don't get to see our beautiful faces, but we are still here and ready to rock. There's a lot of stuff to talk about today. Had Josh Young on the Gold Rush yesterday. That was a really fun interview that we got to do. So if you guys don't get a chance, definitely check that out. It's definitely on my channel. You can also see it on Twitter. However you want to see it, it's definitely all over the place on my Twitter from yesterday. So definitely go check it out. Talked about natural gas, talked about the energy transition, and a lot more. So for you guys who are interested, definitely check that out. So today, Kashop, I just kind of wanted to start out big picture, which we always kind of do. Let's talk about the dollar. So many people have been telling us, and you and me are probably the ones who are very bearish on the dollar. We continue to talk about how bearish we are on the dollar. And then other people around us are kind of like, hey, the dollar's going to go up here. Look at this, look at that. You're going to see a huge bounce here, huge move in the dollar. So what are you thinking here? Do you think the dollar is going to just kind of continue to the downside, or do you think we're going to see a bounce? What are you thinking?
So I saw a chart by Sam Gatlin the other day arguing for a slight bounce in the dollar on a short-term time frame, and maybe he's not wrong because sentiment has gotten so pessimistic, and some of the other currency charts, if you look at them, they have gone parabolic. Now, what I mean by that is only if you're looking at the shorter time frame. And does that mean parabolic moves can't last? Of course not. They can last, just that we might have a bit of a consolidation. Plus, it's August, it's summer, and this is the time where you're going to get chopped on both sides if you're trying to trade the short term. So I would just say, big picture, dollars going lower next month, or maybe even next 2 months. Forget about it and just focus on the big picture, because there's really no edge to trading the dollar on a 1 month time frame, in my opinion.
Yeah, I think so too. And I think we can always talk about these bounces that are going to happen in things like the dollar or everything really. Like there's always going to be bounces and downtrends. That's something that you just have to know. Currencies less so, commodities less so, equities more so. But if we're looking at the dollar and we're thinking this thing's like it's got to bottom out, like I don't think anybody's wrong in thinking like it can bounce. It can always bounce in a downtrend. But what's the big long-term picture here? Are we looking at this thing to just bounce, or are we looking at this thing to really head a lot lower over the next year? And to me, I think this thing's definitely headed towards 90. I'd be very surprised if the dollar holds up above 90 for this entire year. At the very least, I think we're headed lower this year still. I think if you look at international equities, if you look at gold, if you look at silver, all these things are just screaming lower dollar here, dollar cycle heading lower. So what are you thinking over the long-term time frame, or what are the macro implications that you're looking at that would actually change your mind?
So if you look at the dot com to the GFC period, the dollar kept going lower. Does that mean the S&P didn't perform? It did. But if you were in the S&P and I was in international equities, I did better. It is as simple as that. And that's also because when the currency keeps depreciating, whatever performance you have, that performance is not actually real performance. So you have to account for the currency depreciation as well. So if you look at US equities and the US dollar over the 2000s decade, they did terribly. And if you look at international equities, they did wonderfully. So you want to be positioned where the strength is. And here you have a situation where international equities have been so left for dead that almost no one cares. So if you go back to last year, 2024 March, everyone was talking about why you should not buy the dip in Chinese equities. And the reason for that was Chinese equities have been in a bear market for 10 years. There is no reason why that should change. And let's just stick to what's working, which is US tech, and not go into Chinese tech. And what happened? Chinese tech did wonderfully. And then if you go look at international equities, there was this period where you had all these ETFs holding Turkish stocks, Greek stocks, Brazilian stocks, you name it. And over the last decade, that is 2010 to 20, a lot of these ETF providers just gave up because the ETF providers make money on fees. There is no interest in these ETFs. Their AUM went down. They just shut down the ETFs. And that was a terrible, terrible time to be long international equities if you're a dollar based investor. And that kind of lasted until 2025. And then, boom, it was like a switch was thrown, and suddenly Europe became the top performer, and then Brazil became a top performer until the Trump spat, and then Vietnam slowly took off. And you're starting to see all these moves in different countries, and it's all happening because the dollar is weakening. And if you look at previous weak dollar trends, they tend to last for years and years and years. And the dollar peaked sometime in 2022, and we are not even like 3 years into the current downtrend. So this has a lot of room to run. I think we're going to see some nasty breaks in the dollar, which will surprise everyone. And the parallel for that is you have to go back to 1978, 79, the Carter economy years, where you had heavy stagflation. No one trusted the dollar. You will probably see something similar this time. I mean, history doesn't exactly repeat, but it rhymes. So you're going to see these breaks in the dollar correspond with such negativity. And I think we are a long, long way from that. People are just still looking for bounces in the downtrend, and that's not the trade.
No, I agree, and that's the hard thing about like it's time frames, and I tried to explain this the other day in our portfolio review that we do on Wednesdays, just going over the positions and so on. But I wanted to kind of dig into why I trade the time frame I do, and I think a lot of people go like, "Why do you trade?" You know, like people love day trading, or people love 2 week trades, or 1 month trades, or you'll talk to somebody and they'll be in and out of something before they'll be very bullish on, let's say, natural gas, and by the next week they hate it for another reason. They've already sold after making let's say 5%. So why did I start to switch to the time frame I do? Why are we looking at why are you and I always talking about these very long-term trades? I think that it's because of edge. So when you look at traders, like especially when I was trading at prop firms and funds, when you're trading at prop firms and funds, you have all these people who are fighting for that month-end return. And they go, if I can just, and this is really like, it sounds ridiculous, but let me tell you, there's just as much dumb money at the top as there is at the bottom. So this is going to sound ridiculous, but they would talk about, okay, let's just get a couple percent a month or something. Really the only way to do that consistently is to be Bernie Madoff. Bernie Madoff made a couple percent a month every year forever and ever and ever. It's called fraud. It's the only way to do that, because you can't control what the market's going to do. So they would, talk about, I'd watch traders kind of go, and these are the ones that would always blow up at the prop firms. You'd watch a trader go, okay, well, I'm going to make, let's say, 2% this month, and then I'll just continue to do that each month. I'm going to do great. So they have a good start to the month, let's say. They get to that 2%. They cut off all their positions, and they go, okay, made my 2%, I'm out. And let's say the rest of the month I'm in the trade, and let's say it's a crazy month. It's something where like I get like 20% in a month or something, or 30%, just something crazy, which does happen. And then we get to the next month, and then like let's say I'm down, let's say 10%, and then they're looking for their 2%, and they're down 10%. So now they're down 8%. I'm still up on the year, and this goes over and over again. And really, like, I'd watch one guy had, I want to say 7 or 8 months straight where he was putting to 1 to 2% returns each month, and he was doing really well, and he felt really happy about it. 1 month comes in where he just gets blown up for, I think it was like a 12% loss in a month. And next thing you know, like he's back to square one, he's back to flat. And so like, if you think about it as a trader, you're sitting there on a 1 month time frame, and you're going to get screwed every time you do that, because you're fighting against all these other traders. One, it's also very hard to have big returns. The reason why they say like let your winners run is because 1 or 2 winners can pay for all these small losers if you're sizing correctly. And so like I've always stuck with that. At first it was a quarterly time frame. Okay, everybody's going to fight for this, I'm going to fight for quarterly. At the time, that's how I was paid. So, making good return each quarter was something that was important to me, something I tried to do again and again. But then moving forward, it was okay. Well, if a lot of traders are looking at the 1 month time frame and they want to make their funds look good, say they're up every month, great. But then there's also the other ones that report quarterly, so they want to fight for that quarterly time frame. Then I started to think, what about 6 months? And then what about a little bit longer and so on? And this is where I really found an edge. If you back test this, you find out you make a lot more money over time and handle a lot less whipsaws if you're kind of in that time frame. So it's the reason why when I look at a chart like this, like, and people are going to go, yeah, it's going to bounce or this is going to happen. I'll agree with you, sure, but I'm probably still going to be short the dollar, and that's not going to change over time. So let's move on to the next chart. Gold miners. You and I have talked about it a ton. I remember, what was it, just 2 weeks ago, 3 weeks ago? Gold was struggling. I mean, not my opinion or your opinion, I'm sure, but gold's gonna die. I kept getting these messages from people that were like, look at this triple top. I mean, like, man, it's so short term to even think that when you're in an uptrend and you're drawing triple tops on something over a, let's say, 5 week period of time, like, you're missing the point. That's consolidation. Sure, could you be right? Yes. 1 out of 100 times you might be right on that, but most of the time, the 99 out of 100, out of 99 times out of 100, it's going to head into an uptrend more often than not. So when we look at something like gold miners, we're seeing the same thing, and people continued to kind of overlook the fact that gold miners were doing so well, or overlook the fact that silver was doing so well. And to me, it's like, we're in a precious metals bull market. And the gold miners and the junior gold miners and the silver miners, they're all telling you the same thing, which is this thing still has legs. It isn't going anywhere anytime soon. And it goes with that macro picture. So what, Kashop, I want to ask you, what are some of the, I know you don't want to give away some of the names you give out for your service, but what are some of the things that you like look at in the majors that are something like you might hold for a long period of time?
So my approach here is a little different because I know the space extremely well, and I was in the majors in 2023 and 2024, and right now I'm in the mid-tier producers and leaning more towards the junior producers and the gold explorers. And the reason for that is, if you look at liquidity, that's how it cycles. So at the start of an uptrend, and although I would say gold bottomed in October 2022, the uptrend started sometime around October 2023. That's when the Fed came out with their so-called pivot and everything took off, gold took off. And at that point, it was the perfect time to buy the big mining companies. And the reason for that is the capital is always going to go into Newmont and Agnico and Barrick at the start of the rally. But as people get comfortable, once they realize that this is not a head fake but a trend, and once they see the gold price steadily climbing higher, risk appetite becomes a little more. And people say, okay, instead of sticking to the major miners, let me go into the mid cap miners. Let me, instead of sticking to US and Canada and Mexico, which are known mining jurisdictions, let me go to Nicaragua and Bolivia and, name all the other exotic countries. And they start to think, okay, if Agnico is trading at, let's say, 30 times sales, which is high, let me find a stock which is trading at 10 times sales. And I know that's not the metric in which to measure it, but that's the metric that I'm seeing other analysts use, so I'm just going with it. And so what happens is capital comes into the junior space, and I want to be positioned in the companies where the capital is yet to come, or it's kind of slowly starting to come, but it's not quite there yet. So that's where I am. But if you're talking about the major producers, then I see no problem with almost any of them. Like whatever you pick, you can't go wrong. I don't really like Barrick that much because, funny story, gold is entering a bull market, and Barrick Gold, which has the GOLD gold ticker symbol, decides they don't want it after all, and they change their ticker to Barrick. which is B. And they say we are not going to be associated with gold anymore. And I'm like, what? How does that make sense? So I don't like Barrick at all. And Newmont, the problem with Newmont is it's going through a bit of a digestion process. They acquired way too many mines to grow big so that they get a bigger allocation in the GDX. And now they're kind of in the digesting phase. So Newmont will do okay. It will not do great. So I would leave out Barrick, I would leave out Newmont, I would leave out Agnico because the valuation is so far ahead of itself. How much are you really going to make at this point? Not much. And so I would start to go lower down the chain. So you still have your royalty and streaming plays, and then you have your risky South African producers, and then you just have to keep going down. So I think that's where the value is. Like you can stick with what's in the GDX, what's in the GDXJ, and Sprott has a new active gold mining ETF. So you can stick to all those ETFs and let them do the work for you, or you can really start to dig into the space. And I think this is the time that you can make a lot of money digging into the space.
Yeah, I do think it's a good time to really start digging in and finding where you want to be. Interesting one that Josh said yesterday, and this is part of the conversation I thought you might find interesting, which is he was talking about 2021, and he was saying, the energy, like he had these really insane returns for, I think he said about 1,000% between 2020 till mid 2022. And so he was in a ton of small cap energy producers. And he mentioned that the one thing he would do differently is realize that the small caps weren't really outperforming. On an absolute basis, they were, but relative basis, they weren't really outperforming the large caps at that time. And so he would have maybe thought that, hey, maybe this energy market is going to come to an end. Kind of looked at sentiment and more. It's more in depth than that, but that was kind of part of the conversation we had yesterday. And so, the one thing that you and I can talk about, which is, and this is where you're getting at, we're seeing the opposite in gold. Gold miners, the juniors are outperforming the majors. Especially if you look at the explorer sectors, I mean, it's all starting to really show massive outperformance. Silver is finally outperforming. That hasn't happened in, I don't even know how long. I mean, we literally have kind of waited for that signal for a really long time. I do think I have a silver to gold chart in the deck. I don't know the exact number it is at the moment, but we'll get to that in a bit. But kind of, looking at this, and the reason why we talk about this is because we're looking at risk on in the market. It's the idea that you're going to look at gold first and you're going to see gold moving, and people, basically you're looking at some crazy people stuffing it in their they're burying it in their backyard. You're looking at central banks buying it. You're looking at some futures traders buying it, and so on, and you're seeing gold start to move. But if you see silver underperforming, it's not really the best signal that gold's going to continue. And then finally, we start to see the rest of the cycle start to pick up, whether we're looking at major, like Kashyap said a couple years ago, that this is right when gold is breaking out. We're talking 23, 24. He's buying the major producers in the gold mining space. So, the big names are now starting to move. They're starting to move back. Sorry. The big names are starting to move back then in 23, 24. And then we get into 25 and the cycle really starts to kick off. We're seeing gold really start to move. We're seeing silver finally start to get above some major levels, getting above 30, 35, and so on. And then we're seeing the juniors start to move like crazy. So the mid-tier producers is what he said. So basically starting from the large cap names to the mid-tier names, basically mid caps for you guys out there, and then getting into the smaller names, the juniors. So when you're looking at this cycle, like you have to see like, hey, this has legs. And this is the reason why we're so bullish on it still. If I wasn't seeing this, I would not be as bullish as I am on it.
Yeah, and also have to understand that commodities move for a trend for a very long time. So it's not like other sectors where you may have 2 3 years and then there's a rotation. Here, you're going to see secular long-term trends, and That's just the nature of commodity cycles, and there is no logical explanation to it. It is just the way it is. Studies have been done on it. So, in fact, if you go back to, I think it was NBER, which put out a paper called Facts and Fantasies on Commodities Futures, where they showed that they tend to be kind of the opposite of stocks. And when stocks have a bear market, the commodities tend to do well. And if you look at the paper and the conclusion, it's like these trends can last for a long time. And with gold, we are just getting started. So, like from October 2023 to now, that's like not even 2 years. And only now silver's moving. Only a few months back, platinum and palladium started moving. So, we have a long way to go.
Yeah, and something, I talk about a lot, which is this would be the shortest commodity cycle ever, right? Like if you really like looked at 2020 and said, okay, that was the bottom, which I absolutely believe that is. If we stopped in 2022, that would be the shortest commodity cycle in history. And that's not something we usually see, where we see these big moves. And then let's also look at it this way. Gold is just ripping to these levels, and you're going to tell me that the rest of the market isn't going to make that move as well, like the rest of the commodity market. Like, it doesn't make any sense. So I think there's definitely legs here. Once again, not saying like I'm going to go in and start buying up all the energy stocks today, or I'm going to go in and I'm going to start buying up every natural gas stock today. I'm saying take the signals as they come, trade them as they're moving. Just like Kashop mentioned, you're buying the majors, and you're buying the mid caps, and you're buying the juniors. Like, this is how you trade these style of cycles, because at the end of it, we're going to be, Kashop's going to come on here and he's going to be like, yeah, I'm buying this company. Today he's talking about, NEM looks like this and it's not managed like this, and so on. In probably, let's say, a year from now, if we're still in this cycle and it keeps moving the same way, Kashop's gonna be like, yeah, I own this company. It's basically a hole in the ground with a liar standing next to it, but everything's moving right now, and that's kind of how these cycles end, which is at a certain point, like, we're going to see this crazy amount of FOMO in this market, and you're going to see people just plowing into just about anything that says gold on it. And it's the reason why, like, it sounds insane that Barrick would just want to take gold off of their name. Like, that's the best ticker you could have for a gold miner. But when we're looking at these cycles and we're looking at this stuff, like, we have to understand, like, we start with the majors and we move down. When we're right now and we're looking at even energy, like, we're going to start probably, like, not even now, but when we start to see, for me, it's going to be breakouts. For Kashop, it might be something else. When we start to see, for me, like, we get over, that 100 level on XLE, I'm going to probably want to own the majors first, and then I'll probably move out down in the sectors and down in the cap scale until I get to a point where it makes more sense. And then I'll probably get into very speculative things down the road. Not probably as much as Kashop can. I'm not as smart in that smaller micro cap style sectors as he is, but that's why I think it's very important to just understand the cycle, where we're at and where we're headed. So, speaking of the cycle, big picture here, when we're looking at the Fed, and everybody right now is going, hey, Fed rates are going to do this, Fed rates are going to do that, which is all possible, right? Like, we could be in a scenario in 2 weeks where there's some big infighting thing, or let's say inflation just gets out of control, and we get a situation where Powell's like, hey, I'm gonna start raising rates. Not even that he's gonna do it, just saying it could be something. And then also we could be in the opposite scenario very easily, where we get a new Fed chair, or Powell retires, or something happens and he goes, hey, I've got enough money, I'm an old man, time to take a break, I'm out of here, this is too much stress for me, and he just moves on from it. All possible, obviously. So, what way are you leaning on this, Kashop? Because I have, like, my own thoughts. I'm not exactly clear. I'm kind of just, hey, whatever way the wind blows at this point, I'm probably going to head that direction. So, do you have a more clear picture on what you think the Fed's going to do going forward?
Sure. So I think you nailed it where you say whatever way the wind blows, just go to lean in that direction. And That's pretty much everyone's thinking right now. And that is actually consensus. So if the treasury starts doing buybacks, their own version of Operation Twist, then the consensus opinion is going to be 30-year yields come down. Now, if the Fed cuts rates, there are two camps. One is last time Fed cut rates, 30-year yields went up, and that's going to happen because inflation is going to rage. And there's the other camp that says Trump will gain control of the Fed, and we are going to get some kind of yield curve repression, meaning they're going to target the long end and not just the short end. So these are all the consensus opinions people are uh, toying with. But what if, just what if, the Fed is no longer in control of the yield curve? What if the bond vigilantes are back? Now, we haven't even heard the term bond vigilantes since the 1980s and the 1990s during the Latin American crisis. But at that point, what we saw was the bond market was in charge of yields, the bond market was pricing everything in, and it was in the central banks. All the central banks, including the US commercial banks, they all completely lost control during the LATAM crisis. And it was the bond vigilantes who were in charge. Now, what if whatever Trump does, whatever the Fed does, it doesn't matter and the bond vigilantes are in charge? Now, at that point, 80s, 90s, the bond vigilantes were just, uncoordinated groups of people who were holding bonds as a investment. But right now, you have geopolitics also as a factor. You have the crypto stable coins also as a factor. So what if so you have Tether, you have Circle, all these guys issuing stable coins, and they all hold treasuries. Now what if they change their policy and they are like, we want to do something different, we want to move our funds out of treasuries, let's say, and into something else? And then you have these big governments, like we had this blow up in Taiwan the other day because they had an asset liability mismatch, meaning the Taiwan dollar shot up and the US dollar went down. The TWD USD exchange rate had a big move. And what happened was they realized they had all their assets in US treasuries and all their liabilities in Taiwanese dollars, and there was a scramble to sell. And you saw Northern Chunkin kind of blow up last year because it had the same issue. They had a huge portfolio of US treasuries, and those were just losing value every day. And finally, they just decided, no, we have to get rid of this. And then you have the same issue with China. China holds a lot of US debt. Now, if there is a trade war, then that becomes a weapon. And geopolitics is not something that you can trade in an actual time frame, because I mean the China move, people have been talking about it for a decade, so it's not like it's going to happen tomorrow. But if it does, or the point being that bond vigilantes right now are sovereign actors, institutional investors, and the entire world which is long US dollars. So if whatever happens with the Fed, whatever happens with Trump, if the bond vigilantes get in charge and start driving US rates and the US dollar, then there is no telling how this will blow. And I think that's the scenario no one is set up for.
No, I agree. It's there's so much going on here right now. That's like it's kind of like that's why the thing is for both of us. The first thing we both talked about is it's overwhelming to a point where it's like it's not going to really give you some crazy edge to know exactly how this is going to play out beforehand. It's going to the edge is going to come in being flexible and just having the understanding that we might go up, we might go down. But I think here's something that I think is important, which is if we're looking at this in a way that hey, the Fed comes in here and lowers rates, or let's say Powell stays in for the next 50 years and holds rates steady. For I'm just saying he signals that that's not exactly what's going to happen, but let's say he's just signaling till the end, he's just holding rates steady, he's being data dependent and so on. I don't see a scenario here either way where we get into a situation where it starts to put pressure on commodities. I think if like people keep telling me this, oh, if we get into a thing where the Fed's lowering rates or there's yield curve control, we're going to be in a scenario where commodities are just going to get crushed. I would be very surprised either way that commodities get killed in any way. I think that yield curve control, we'd probably see commodities catch a bid. Um, Maybe it's something where it's delayed. Maybe there's a deflationary shock. Maybe there's something, and I'm more saying like think about like 2020. You know, most of us thought that commodities would probably start to move around the end of 2019 and the beginning of 2020. And then we had the most deflationary event in history, which was COVID. So COVID happens, boom, deflationary shock. Everything gets smashed very quickly, commodities especially. But you know, then they go to infinity and so on. Next thing you know, commodities are moving up at a crazy rate, outperforming just about everything out there. And that's something that was a huge shift in the market. And so looking at it today, like I think that that's um, the biggest black swan for commodities is the fact that we could have that situation where everything just crashes all at once. And I don't think if they lowered rates or something like in the front end of the curve, I think if they lowered rates in the front end of the curves, I think commodities would explode. And I'm talking everything. I'm not just talking gold, silver. I'm talking oil. I'm talking the dollar's going to get crushed. I'm talking a lot of things here because I really do believe that that's a scenario where commodities just take over once again. Yield curve control, maybe we could see a deflationary shock very quickly, but I think that would shake out and move forward. Do you think that, you know, if they did either one of these, that it would put a lot of pressure on the commodities market?
I would be very confident being long commodities no matter what the Fed or the US government does at this point, because the genie is out of the bottle. There is no stopping it. And now that everyone's seeing the commodity cycle and looking at, so let's take palladium. Everyone knows palladium has been in a supply deficit for what, a decade. Same thing with silver. And these deficits are not going to get cleared. And we also know that Russia is a huge source of supply of palladium, platinum, nickel, all these things. And then now you have this trade war, and you might have a hot war coming soon. So do you want to be long the metals which are in a supply deficit which cannot be printed, or do you want to be long bonds and all these stuff that can be easily printed? And I think the answer is clear. You just want to be long stuff because it's an inflationary environment. There might be a war going on, there are supply deficits. So it's really that simple. You don't need to complicate things. Like, do you want claims on financial assets, or do you want to have real assets? And I think the answer is obvious there.
Yeah, I agree. It's just it's a very simple scenario here to understand, but I feel like a lot of people are going to still be in the camp where they're like, "Oh, well, deflation's going to happen." And I really think like disinflation in a big way is most likely not happening. Like, sure, we could see situations, liquidity events, and so on, but like real long term, like in disinflation, and you know this, and I know this, which is the last time you really saw anything like that. You got to go back to the beginning of the 19th century. You know, like we don't have crazy deflation anymore. They have just kind of baked in that we're just going to have inflation forever as part of the policy. So that's always a kind of fascinating conversation to me, but maybe we could get into that more at some point. Um, I have just a couple charts to go through. This one was just something that was kind of sticking out to me. I kind of wanted to bring up today, which was funny. Um, Sam and I were chatting about this yesterday with Dan in the group, and I was just like, man, I went in, I was looking at my somebody wrote about gold fields, and I thought they were writing about feeder cattle, and I was like, oh, you're not writing about feeder cattle. And I looked at like my position, and I was like, I have been long feeder cattle, at least a half a position for way too long. Like this is insane. It's one of the craziest trends I've ever been a part of. And if you look at the recent one, basically go back to it kind of bottomed out in the beginning of or the end of 23, beginning of 24, started to move higher once again. but we haven't had a down month since last September of 2024. That's wild to me, and I don't know if I've ever seen an end run. I'm sure somebody's gonna be like, "Yeah, this one stock or something." I'm sure there's plenty of things out there, but I don't know if I've seen a commodity have an end run like this ever. Just month after month after month, every month is up, going all the way back to September 24. Now, yeah, gold does it at times, silver at times, and so on, but seeing it in like a actual agricultural or soft commodity, it just doesn't happen much.
Was
Um,
it was Coco doing that in 2023, 24?
Cocoa had a big move, but it had a couple like down swings in it, so I'd be surprised. I haven't looked at it on a monthly chart in a long time. It's been just kind of chopping around for a while, it's starting to move now, but just kind of cocoa might be one. Lumber might be one going back to 2021, but like I had just haven't seen something like, especially in the meats. I've never seen it happen in the meats. They're always so volatile. They go up, they go down, they get hit quite a bit. Um, but this has been such a steady, strong trend. And I think the thing that's I know a lot of people don't trade cattle futures like me, but at the same time, it's like go to the grocery store in the United States. Like it's just I know you're a vegetarian, but a lot of people in the United States eat meat. Plenty of vegetarians though too. But if you eat meat or have anything, like I remember us talking, and it sounded crazy to have like a freezer full of meat. This was what going back to 2020, I think you and I talked about it. But now it's like almost you kind of have to do it, because if you don't do it that way, you're spending. I mean, literally, like if you look at the grocery store and you go to buy like a steak, just one steak, it's about $12. And I'm just talking about like that feeds maybe one person, per one meal. And so it's like you're looking at, like, let's say a family of 4, if you're feeding them steaks, like not everybody's feeding their kids steaks every week, but let's say you're feeding your kids all steaks and you have 4 people. Um, you're spending, close to $50 just to eat dinner now, and you're making it at home. I mean, it's just getting crazy. So I think the main thing I wanted to bring up here is that at some point this ends, and I don't know if it's the fact that more people are eating meat now. I know there's lots of problems with the herds. I know there's been issues with feeders. I know there's been a lot of issues in these markets, but I still think that it's at some point it's got to get unsustainable. Um, and why I bring that up is that at some point, and I'm not betting against it today. I'm still long feeders, even though I've kind of bet against or talked against it a bunch of times. I haven't made a bet against it. I haven't shorted it. I haven't taken off the position. The trend is up. I'm just going to ride it. But if we get to a situation where this thing finally rolls over, like that's the signal you're going to need for all of you guys wanting to buy corn, soybeans, all these things. That's the signal you're going to need to really do that. So let's pass up a couple things to shop. I want to give you a sec to talk about your latest research.
Sure. So, guys, you can find me on Substack now. So I'm going to be posting a lot more long form articles and some from my paid newsletter as well. So I would really love it if you read the latest 2 articles. So the first one is on everyone's talking about Trump and Russia and all the stuff that's going on. So I just thought I'll give a background on how it all began going back to 2012. Like, I mean, you can go all the way back, and history buffs, me, Jason, especially, we keep chatting about what happened in the 1920s, 30s, and all that. But I just thought, let me keep it short. 2012 to present, how the Ukraine-Russia war began, what was the US influence there, how did the US influence the EU? We talk about the Nord Stream pipeline, everything. That's one article. And the other one, I just talk about wind resorts. So this is in my portfolio. It's my number 3 position. I'm already up 30% on it. So I just thought, it's a good teaser of what kind of stuff you get in the paid newsletter. So I just put it up on Substack. So follow me there, and I will put out more exclusive content for Substack.
Sounds good. I just put it in the on the YouTube channel. I'll put it also on my page on Twitter. And all right,
Thank
guys.
you.
I will see you guys next week. Probably same time, same place, 10 a.m. Eastern time on Fridays. All right, guys.
Bye, everyone.